Sejahtera. I would like to solve this question regarding the topics of cash capital budgeting and cash flow estimation. Before we proceed, okay, this is the question. The question of capital budgeting, cash flow estimations, and we want to calculate the initial investment or initial outlay, annual after cash flow associated, and terminal cash flow. So this is the question. You are required to evaluate the purchase of a digital textile printing machine for the production department. And the purchase price is 150,000. So this is the initial investment, and it will cost another 20,000 to modify the machines. In some is this is we have to include this 20,000 to the cost of the machine, because of if we do not include, then the machine will not operated. The machine has an expected life of 5 years. This is a new machine uses life, and more space of machine will be zero. The machine is depreciated using the straight line method. Straight line method meaning that the cost of machine will be divided by 5. And if we use the new machine expected, then after we purchase, then we use the machine, then our sales will increase by 10%, and cost of maintenance by 50,000. Cost of maintenance because of we are using the machine, new machine. Due to increased sales, the first spec an increase in working capital of 8,000. For example, we have to increase in working capital 8,000. This is outlay investment out. This is outlay flow and finally, to purchase the new machines, the firm would have to borrow 50,000, and this is respect to interest of 8%, that is 4,000. The question has already calculated to you the interest payments. The firm's marginal tax rate is 35%. This is short questions, and we need to calculate the initial investment, annual after tax cash flow, terminal cash flow, final year. at year 5. Then for this question, so this 150,000 fall under initial investment, and this also modify the machine. If 50,000 is included in the cost of machine, then the cost of machine will be 170,000 ringgit. And 70,000 is derived from the calculation of item. Then this is answered on question A, and question B is after we purchase the new machines, then we have to operate the machine, and we expect the sale will increase by 100,000. So this cash flow is just like as a profit and loss statement. The format used is rather or slightly same as the cash flow or profit and loss. All right. So the sales at the top and the expenses immediate after the revenue. Then this is the sales or our income. And this is all this thing is cost or expenses. Our cash is reduced. Then we expecting that our sales increase by 100,000, and at the same time our cost will also increase in terms of cost of maintenance, 50,000. Here, and the question have given you the figure of 4,000, and also increasing depreciations 34,000. I'll get this 34,000 is derived from the cost of machine 170,000 divided by 5 years, then you'll get 34,000. Then this figure, why you have to calculate the interest and depreciation here is mainly for the calculation of net profit. And then we get the net profit before taxation is 4,000, and because of that you can calculate the taxation of 35%. This is taxation 35%. If you want to calculate the taxation is like the net profit before taxations. After taxation is 3,000, and this is what is not relevant cost. One is in interest and one is depreciation. This is not cash involved. Then you have to add back depreciation and also add back interest, 4,000, because of this is cash flow. This is capital budgeting, because we are already we will calculate the firm cost of 10%. Okay, so to calculate the net present value, then the interest is slightly same as a firm cost of capital. Then we have to exclude it, or add back the interest 4,000. Then you have you get the after tax. You have to total it 3,000 plus 34 and plus 4,000 and get 40,000. This is for year 1 to year. Because of the question for C is terminal. Terminal is at the year 5 because of our machine useful life is 5 years. Then the figure is slightly same. It's same as what year 1 or year 2, year 4. Then the question required us to calculate the terminal or the 5 year. Then figure is slightly same or exactly same. 40,000, 41,000. Then D question is you want to calculate the net present value. This is very important question. Net present value is you need to calculate the present value. Okay. Okay. In initial year, 170,000 is from cost of purchase of machine. That include is our money is coming out. So our money is negative, or we are using our money to purchase, then our money is reduced by 170,000. I always use the negative for money as money's out. And for year 1 to year 4, for year 1 or year 4 is any. If I draw, and this is year 4, and year 2, year 3, year 4, and year 5. Alright. So at every year we get this 41,000, 1K, and children or the annuity, and this is the annuity. So we are use the table of annuity BIFA. Then refer to your table PBIF A, PBIFA, table A4. Okay, 10% and year 4. Then you get 3.1699. This is PBIFA table. 3.1699. Then you will get 41,000 times 31699. You will get the 1299. And for year 5 is single. It's not any. This is present value. Then you use PVI for year 5 PVIF. Then we use table A3 10% at 5 at year 5 0.6209. So then you just multiply here 41,000 0.6205. Then you get 25,457. Then this is present value. So it's the future value and at the present value at year 0. Then 107,000 is 100,000 because of it set at the present value here is same as 170,000. And that is 129,966, and here is 35,457. So sorry, 100,000 plus 129,966 14,577. They were negative figure. That means this is what we call as NPV is negative. Then if you're positive, you should buy the machine. But if the value of net present value is negative, then you should not buy because of some sort of loss because of the buying the new machines. So in question E, what is question E is need to separate the financial decision from the investment decision in preparing capital budgeting. Okay, this is my suggestion. We have already seen that there are a lot of difference that arise between what we have learned in accounting and how we use in corporate finance. The separation of financing and investing decision is one such important concept. It is important because we have to make a very important adjustment based on this principle. The adjustment is the fact that we do not subtract interest costs. So remember that to calculate the income tax, we have to include the interest. But if we want to calculate the financing, we have to exclude the interest because of we already consider the cost of capital of 10%. And the firm cost of capital is 10%. Okay. Then we have to exclude the interest and also the depreciation. Depreciation is not involved in the financing because it's not cash flow or not involved with cash. Depreciation is just provisions. It's not involved in cash. Then we have to add back. Add back means we already minus in depreciation, but if depreciation is not involved in the money, then you have to add back. So you have to remember here. Here. And we have finished answer these questions. Okay. Thank you, and don't forget to